Okay, here we go. This is going to be the strategy video. I don't see it being too long because it's relatively simple, but I will go through a couple of examples on the chart, which may make the time slightly extended to, I guess, around 20 minutes or so. We'll see. All right, so step one in this strategy, and it's the same for many strategies, no surprise, it begins with market structure, right? As we know, financial markets, they don't just move in one direction consistently. There's always an ebb and a flow of higher highs, lows or lower highs, or lows. So in order to simplify the concept of market structure, let's describe it as the major highs and lows within a price chart. These major highs and lows can be referred to as swing points. Okay, and you can see that here, marked by the fractal triangle levels. So we've got a 3 candle play here, 1, 2, 3, which marks the swing point here, and the same here at the bottom, 1, 2, 3, and then price moves up, and then 1, 2, 3, price starts to move down again, and again, 1, 2 this time, price moves up. So market structure, swing highs, swing lows, relatively basic concept. Now, the next part we look for after identifying the market structure is a break of structure. So let's just say that we are in a downtrend, and at this particular point here, prices move downwards. It's retraced. That's the ebb and flow that we described. And then if we're looking to take this lower, we want to get confirmation first of a continued break of structure to the downside. So it's taking out this swing low here. It doesn't necessarily matter about this point here or this point here, because those are not marked as the major swing high or swing low areas. This one is. So as soon as it does break that point, that is considered a break of structure. And this is something that is very, very important in this particular strategy. Okay, so number one, market structure. Number two, break of structure. And then we're on to imbalance. And this is something that's been mentioned, and many people use this. And you can stop, play the video and read the area about imbalance. But I think most people understand that it's a 3 candle play where candle 1 and candle 2 and candle 3 play out, where the second candle between 1 and 3 is so large that it leaves an inefficiency area, an imbalance area between candle 1 and candle 3, so that you can see here. So once again, here's candle 1, here's candle 2, here's candle 3. The area between candle 1 and 3 is so great that it's left a massive void or imbalance area behind. And what you'll tend to find is price action will gradually tend to navigate back towards that area of imbalance, fill it once more before continuing on its way. Okay, so market structure, break of structure, areas of imbalance, and the last one, the Fibonacci tool. Now, the Fibonacci is not necessarily an indicator, it's just a measuring tool to measure out premium and discount levels. Now, any purchaser of something would like to get the cheapest price possible. You'd like to get a discount, and the same is true as traders. You'd want to find the best price possible. Buy low, sell high. So in this example here, we simply anchor the Fibonacci tool, measuring out the retracement levels of 71 and 79% respectively, to the last impulsive swing, major swing point low, which was here, if we are looking for longs, that is. The opposite is true if you're looking for shorts, to the swing high here. Now we've already got a clean break of structure, which isn't marked on here, but if you look to the left and look to the right, price has clearly climbed higher. So we've got our first checkpoint here, break of structure. We've got the identified swing point high, and then we've got an area of imbalance that's been created here between candle 1 and candle 3, which creates that inefficiency area. So we mark out our tool, and the idea is that we would set a buy limit order or a buy around this zone here of the 71 to 79% level. Now this is good because if you do so, that gives you a pretty decent 2.43 risk to reward ratio on a buy and or sell trade if you're going in the opposite direction, that is. The stop loss would go just below here, the 1, so just covering this low here, and the target would reach the top level or the 0 of the Fibonacci. Okay, so this is probably best described on the charts, which is where we are going to go next. So, pound Japan, daily time frame, and of course everything here is in hindsight, but what I'd like to do is mark clearly out this long bullish uptrend. So we've got the market structure. So the idea is now just to go back and backtest where we could have used these trade setups in a clearly bullish momentum pound Japan. Okay, so there's the daily right there for you. I've also got a second part which I like to add on to this as well, which is using the MACD and stochastic RSI. This is an extreme bullish trend, and they don't always last this long. I mean, this has lasted, 306 days. So yeah, anyway. But we'll do that after this example. So daily clear uptrend, that's dropped down to the 4 hourly now, because this is our entry on the 4 hourly. And at this point here, break of structure. We do get that. We get this very large impulsive push to the upside. However, I wouldn't be totally confident in taking this one yet because it hasn't closed above this level just yet. But this will be taking it at the absolute earliest opportunity. But because we know this is a bullish uptrend, let's just see what happens here. So we have our swing low here, and we've got our swing high point here. Okay, so what we then need to do is mark out break of structure right there. The area of inefficiency, which is between candle 3 and 1, which is here. We set our Fibonacci tool, anchor to the bottom of the swing low and to the top of the swing high. Now we can zoom in a little bit more. We would then set our buy at the 71%, target the bottom of this range. Sorry, the stop loss goes at the bottom of the range and the take profit goes at the very, very top. And, oh, no, sorry, that's the wrong level. So there we go. That's it. So that would have been a take profit. Nevertheless, this one here would have been a little bit too early for my liking. I would prefer to just wait a while to see if we get a continued confirmed break of structure to the upside. So let's see if that happens. So let me just delete that one now, and delete that one, and delete that one. And I'm just going to put an arrow here to mark where we entered that trade from, just so if I need to come back to that. Okay. Okay, next, break of structure. So we've pushed back down. Price has broken the structure here. What we can then do is look for areas of inefficiency. We don't seem to have any apart from maybe this area right there. Yep, and you can see that it has been respected. We've then got the last impulsive leg wasn't this one, but it was this one here. So we've got 1, 2, 3. That created the swing low. We anchor our fib to the bottom, and then we'll anchor that one here to the top. And all we would then do is wait for price to come back down into this area of value. We would set a buy limit at the 71, wait to be tagged in, which we were. So if we were to just play this backwards, this would already be preset because you're waiting for price to come back into this area of discount, remember. Price comes down, tags us into the trade. Stochastic RSI agrees, although the MACD is slightly slower, but that's its nature. And then we just sit back and wait, leaving the stop loss. You don't touch anything, and just wait for price action to do its thing. And there you go. We eventually get a full take profit after price has come back and tapped this area twice. Okay. So that's another win. This trade would have been slightly better. I probably wouldn't have entered the first trade. That one was a little bit too quick. But nevertheless, that's let's just leave that here. We'll go back to it. There we go. That's it. So that was the first trade. That was the second trade. And now we're just waiting again. Okay, so we got our take profit, which was here. And now we go again. So at this point here, we get the break of structure, which is this point here. It's left behind a huge inefficiency, which is there, which is respected. Not a very clear swing low point. Would I be taking this one or this one here? Neither, to be honest, because it's not that clear. If I was, it would probably be, yeah, it's not that clear. So I probably wouldn't have entered this trade. But if I were to choose, maybe this one here, but it doesn't really matter because you can see here that price didn't come down into our discount zone anyway. So it wasn't a very clean swing high and swing low, which is ideally what we're looking for. But that's okay. Right, next. So swing low, there's this next swing high. We've broken that here with the break of structure. So we've got that checked off. We're still in a bullish trend, as we know. If you look at that, there's the H4 inefficiency, fair value gap. We have this, and here we have a much cleaner swing point here, which hopefully you can see that. So we'll anchor that here to the bottom. And that one there, and then take that to the top. This one's a very clean example. And again, 71%, which falls beautifully on the H4 fair value gap. If you see this, again, this has all been created from that bullish impulsive break of structure that left behind a H4 inefficiency. We simply just sit back and wait for the swing high to be formed, set our parameters, which is the stop loss here, take profit there. It taps us in here very cleanly, an immediate rejection off of that H4 fair value gap. And looking at the stochastic and the RSI, stochastic RSI and MACD, they both agree, especially the RSI, which responds much quicker. So that was a nice example. And I think here we can do one more before we look at the step 2. So we'll just take this break of structure. So we broke through that old high. So there's our break of structure here, right? Next, did it leave behind inefficiency? Well, yes, it did. Between candle 3 and 1, it's there. And a nice clear swing point here and here. Again, we'll anchor our fib to the bottom of this and target the top of that. And as always, we will just set, that's where it would have tagged us in at 71%. Now in this example, you'd probably see straight away that price action has dropped significantly below 71, almost to the probably the 90% area on the Fibonacci. But that's okay, because we just keep our stop loss here just before the last major swing low point here. And then that's a lovely take profit right there. So as simple as that. Market structure first, then you're looking for breaks of structure. Ideally, what you're looking for, an A+ setup, would be strong, bullish, impulsive moves, either to the upside if you're buying, longing, or downside if you're shorting. Then mark out those areas of inefficiency, which we've just done to here, because they tend to act as a magnet for price to be drawn back into. This is where you're looking to either buy or sell, again, if you're doing a short, and target simply the old swing high, and the stop loss goes at the last swing low. And that's really as easy as that. So we've got a couple of really nice, clean examples here. And I'm just going to just mark that one out here with an arrow as well. If I need to come back to that in just a moment, I will. Okay. All right, yeah, so a nice couple of examples there. Let me just go back here and reiterate what I said. So number one, you're looking for market structure. You want to get the overall bias, and once that's confirmed, then you're waiting for number one, which is the break of structure. Once that has broken structure, you are then waiting for areas of imbalance to fill out, because these tend to act as magnets for price to draw back into. And this is where we can anchor the Fibonacci tool. So again, in this example here, we've got a nice swing low here. Price is pushed up aggressively, which is great. It's left behind a H4 imbalance, or an imbalance. We don't know it's the H4, but here's an imbalance anyway. This is where we anchor the Fibonacci tool. Simply just wait for price to come back down. If you're not going to be at the charts, this is where you set your buy limit in this case, because it is going to be a buy. Stop loss goes here, target the old high, and you take the lowest hanging fruit. So hopefully that makes sense. Now there's one more example here that I would like to go through, and that is how I utilize the MACD and stochastic RSI. Because if I zoom back out of here, and again, this is where those arrows came in quite handy, I could have just followed this and just took these buys, albeit probably with a couple of losses along the way, but that's fine. But overall, I probably would have been profitable, almost certainly, with this clear bullish directional trend. Now, on the daily, like I said, this has lasted from April 2025 all the way through to February 2026. That's like a 10-month bullish trend. Now, it doesn't always last that long. Sometimes you get trends that only last. So for this case here on a daily, before it starts reversing, 14 days. And this is where I use the MACD and stochastic RSI just to see if we can take advantage of these moves as well. Okay, so let's pick this one here. And I'm just going to highlight this so I don't forget it, and take a look at the MACD, which is, yeah, just here. So it's clearly an oversold position. It's way below the zero. We've got a nice clean green signal, and the lines have separated quite clearly, and we've got nice bullish momentum pulling up. Now, I said this short-term daily directional push didn't last for that long, but let's take a look at it and see if we could have taken advantage, something beyond a trend that would have lasted a year. And yeah, let me just clear that off here. Okay, so the first thing we want to work out is the breaker structure. Now, I don't usually take the initial breaker structure, so here is the first one there. I'll just label that breaker structure here. What I tend to do is just wait for the second one to play out. So let's take a look here. So I'm going to move the breaker structure to this point here. So price has broken this level. Maybe I should have left that one as well. This one here. It's pulled back. There's no area of inefficiency from this one that we can see. And actually, if you take a look, the swing low and the swing high has only been played out by 2 bars. So that's not the cleanest of swing highs and swing lows. So this is a slightly higher risk trade and not one that I would probably prefer to take. But nevertheless, we can anchor from the bottom of that swing to the top, and you'll see here that price would have tagged us in. Ooh, actually, no, that wouldn't have tagged us in because it's above the 71%. It's at the 63% level. But ordinarily, you'd like to set your target a little bit lower to get a better discounted price. So yes, price did retrace back into this level. However, before it got there, it already tapped through our target. So this one would have been voided. So this one wouldn't have been a trade that we really would have taken. And again, I guess that's typified with the unclear swing highs and swing low points. Now this one here, for example, a clear breaker structure, area of imbalance that was left behind. Let's see if that one gets filled in later on. Clearly price, you can see, didn't come back down into that. Yeah, I mean, that price just moved off without this one. So unfortunately, that didn't happen. But this is an important learning curve. What you can see now is that this has created a new swing low. So now our attention is off of this point because a new swing low invalidates this older one. So now we're going to be focusing on this. So we get a break of structure above the swing high. We get an inefficiency level, which you can see has been tapped in once, twice, and 3 times. We can anchor the Fibonacci to the low point here. And you'll see 1, 2, 3. There's the swing high. And we would have set at 71%. Take profit. 2.43, 2.44, and then take profit is reached. That's another winning trade. And then we just rinse and repeat. once again, there's the swing high point from the previous trade. That's the break of structure. There's no area of inefficiency here. We've got a clear swing high point, which is up here, but there is no real clear definition of where the swing low started from. I suppose because we drew down here and pushed back up again, this potentially would be the newer swing point rather than this one here, even though this one's a little bit cleaner. We've got to take the most recent one. So that's just anchor that here. Oops, I've gone the wrong way. Yeah, that's it. So there's the swing low. There's the swing high, this point here. Once again, set to the 71%. Price never comes back down. Stop loss is protected. Absolutely blasts through the take profit in 3 candles. So that one didn't take very long at all. Last example, let's see if this one worked out. Clearly, that's the last swing low. There's the swing high. It's left behind a huge inefficiency, which is just, we're going to mark out here. It does come back into it quite deeply. Let's see how deep it is with the fib. Anchor to the swing low, anchor to the swing high. And this is a wonderful trade to finish on. Actually, no, that one doesn't get tagged in. It gets tagged in at the 63% level, but never made it all the way back down, unfortunately, to the... So our trade would have been left sitting here waiting, but let's see how far we were off anyway. Okay. Yeah, that's a real shame. So we were only 26 points away from being tagged into that trade. But I suppose in hindsight, you've got to look at how large that candle was and how much of that inefficiency was eaten up. So almost all of that imbalance was taken. So it's not always going to work out perfectly, but it was still a valid setup. It just didn't come down to our preferred 71% level. But like I said, this is just a zone. You've also got to consider the area of imbalance, and perhaps you would have been happy at around maybe a 1.5 risk to reward ratio, perhaps, if you wanted to cover this imbalance a little bit more. But of course, that's discretionary. But the same principle applies. Bullish momentum. Look for the inefficiency. Mark out the Fibonacci zone, and then set your take profit at the swing high, which you can see it tabbed in, and then dropped straight away. And then after this, you can see price has now started to swing the opposite way. And maybe I'll just finish off with this one here. Now we're going downwards, break of structure to the downside, right here. There's the swing point here and here. So we would anchor our Fibonacci here to these 2 points. We're just doing exactly the same, but the opposite direction. And yeah, that one there doesn't quite reach the 63% level. So unfortunately, we don't get tagged in here because we prefer the 71% level. But again, if you look at this imbalance here, hasn't really filled too much of it. So I probably would have been inclined to stick with the 71% because that looks about halfway. Take profit there. Trade went in our direction, but it just didn't come down to our discounted zone. So that one was a trade missed, But not to worry, there's always plenty more. So anyway, hopefully that's helped. And once again, in summary, we were just looking at short-term MACD and stochastic daily ranges, which last, this one lasted, let's remind ourselves, that trend lasted about 2 weeks. So 9 days, so that's 2 trading weeks in total. But yeah, we had a couple of opportunities there. So anyway, hope that helps. That's the strategy. Market structure and/or MACD and stochastic RSI, break of structure, inefficiency, Fibonacci level. Maybe I should go back to the PDF actually. That'd be a nice way to finish. Market structure, breaks of structure, mark out the areas of imbalance right here, and then you simply anchor your Fibonacci tool and just wait for it to come into that zone. Remembering, of course, the zone may not be respected depending on that area of imbalance. But you've seen now in 2 cases now that the trade went in the right direction, but just didn't come down to our measuring tool zone Fibonacci level. All right, that's it.